Share capital is the capital which comprises of a number of shares, where you will have lot of investors who will be making investment to the company. Alteration of capital is an internal matter regarding the company, and as such it should be mentioned in the articles of association. In mergers, you should understand that there are three types of mergers. One is amalgamation, other one is absorption, third one is external reconstruction. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session 1 of Unit 3, we will be having a discussion on alteration of share capital. Now let us understand what is the meaning of the word alteration of capital. The alteration of capital means the rearrangement of the capital of the company. So, we all know what is a share capital. Share capital is the capital which comprises of a number of shares, where you will have lot of investors who will be making investment to the company. So, in this session, alteration of capital, it means alteration of share capital, or it may be called as the reduction of share capital, increase in share capital, or any changes made for the share capital. So that we call it as the alteration of capital. So alteration of capital means rearrangement of the capital of a company. So you are rearranging the capital of the company. How can you rearrange the capital of the company? By increasing the share capital, by making fresh issue of shares. Now, suppose the company has 5 lakhs worth of equity shares. So, it is the equity share it has. Now, it wants to increase the share capital. So, it wants to make it 10 lakhs. So, what will it do? It will issue another 5 lakhs worth of equity shares. So what happens? The share capital will increase, or it will sell the shares, more shares to the shareholders, then the share capital will increase. So increase the share capital by making fresh issue of shares. Second one is decreasing the share capital by cancelling the unissued shares. Now, what do we mean by unissued shares? So, we should understand what is the authorized capital. So, what is authorized capital? Authorized capital is that capital which is been authorized by the Companies Act to collect from the public. So, that becomes the authorized capital. Now, in this authorized capital, that part of the capital which has been issued to the public, that we call it as the issued capital. Now, in case the company goes in for capital reduction, it wants to reduce the capital, then it can cancel that part of the unissued shares. Suppose the authorized capital is 10 lakhs and the issued capital is 8 lakhs and the unissued capital is 2 lakhs, then the company can cancel this unissued shares. So this 2 lakhs worth of unissued shares, whatever it has with it, so that it can cancel it and reduce the capital to 8 lakhs only. So that is what we mean by unissued shares. Shares which are not being offered to the public for subscription. So that is what we call as the unissued shares. Then next one is conversion of fully paid shares into stocks. So, whatever is the number of fully paid shares, you convert it into stock. You make a lot of 100 shares, 200 shares, 300 shares, 400 shares. So, you are converting that bunch of shares into stock. That is also an alteration in share capital. Then, reconversion of stocks into shares. So, you have already converted a bunches of 100 shares into stock. Now you are converting them back into shares. So that also we call it as the reconstruction or alteration of capital. Then consolidation of shares of smaller amount into shares of larger amount. Now what is this consolidation of shares of smaller amount into shares of larger amount? Now suppose you are holding shares, 5 rupee shares. So 5 rupees shares, 100 shares. So how much will it be? So it will be 500 rupees. 5 rupees into 100 will be 500 rupees worth of capital. Now suppose you want to consolidate it, you want to just convert it into shares of larger amount. So you are converting this 5 rupees share into 10 rupees share. Now what will be your shareholding? So this out of 100 you divide it by 10, you will get only 10 shares. So instead of having 100 shares, you will have only 10 shares because you are converting the shares of smaller denomination into shares of larger denomination. Then subdivision of shares of larger amount into shares of smaller amount. So you have shares worth 100 rupees. Now you are converting them into shares worth 50 rupees. So this also is possible under the reduction of capital. So reduction of capital or alteration of capital means it can take any of these forms. Either the increase in the share capital, decrease in the share capital, conversion of fully paid shares into stock, reconversion of stock into shares, consolidation of shares of smaller amount into larger amount, and subdivision of shares of larger amount into smaller amount. So this alteration of capital, it will always mean alteration of share capital only. So this we should understand. Then next, what are the legal provisions regarding alteration of share capital? So what are the legal provisions we have regarding alteration of share capital? So the alteration of share capital, termed as alteration proper in the Companies Act of 1956, can be done under the provisions of section 94 to 97 of the Companies Act. So here we have the legal provisions here. So the term alteration proper, that is alteration of share capital, includes so everything. So whatever I had discussed in the first slide, that is, we are rewriting the provisions of the Companies Act of 1956. So increasing the share capital by making a fresh issue of shares, decreasing the share capital by cancelling the unissued shares, conversion of fully paid shares into stock, reconversion of stocks into shares, consolidation of shares of smaller amount into shares of larger amount, subdivision of larger amount shares into smaller amount shares. So this is a repetition of the previous meaning of the alteration of capital. So these are the provisions under which the alteration can be done. Then next one is, a company can make the above alteration of capital. It is authorized to do so by the Articles of Association. Now, can any company go in for alteration of capital? No, any company cannot go in for alteration of capital. So, it can make the alterations only if it has been authorized by the Articles of Association. So, what do we mean by Articles of Association? It is one of the most important document for running a company. So it will contain all the internal arrangements, internal affairs of the company. So whatever the steps the company takes or whatever the arrangements made by the company, it will all be mentioned in the Articles of Association. And alteration of capital is an internal matter regarding the company, and as such it should be mentioned in the Articles of Association. Only if the Articles of Association permits, the company can go in for reduction of capital. So if a company is authorized by Articles of Association to make the above alterations in capital, it can do so by passing an ordinary resolution and by merely altering the conditions of the Memorandum of Association. Now, we also know what is the Memorandum of Association. So, whenever during the formation of a company, there are the two important documents which has to be submitted by any company. So, one is the Memorandum of Association, second one is the Articles of Association. So, in the Memorandum of Association, we have the various clauses regarding the company. It may be the name clause, then we have the capital clause, then we have the location clause. So we have so many other clauses in the Memorandum of Association, and as such, when any company wants to go in for alteration of capital, it can do so by passing an ordinary resolution and by merely altering the conditions of Memorandum of Association. So, they can do so by passing a resolution. So, they can have a board meeting, pass a resolution that the company is going in for alteration of capital, and once the resolution has been passed, only then they can make the necessary changes in the Memorandum of Association, and then they can go ahead with the alteration of capital. No confirmation of the court is required for alteration of capital. So, if any company wants to go in for alteration of capital, it can do so by just altering the Articles of Association and the Memorandum of Association, and there is no court interference here. So, they don't need any permission from the court for alteration of capital. So, alteration of capital must be notified, and a copy of the resolution should be filed with the Registrar of Companies within 30 days of passing of the resolution. So, once they pass the resolution, once they have a board meeting and pass the resolution relating to alteration of share capital, then the same must be filed with the Registrar of Companies. So, they don't need permission from the court, but then they have to bring it to the notice of the Registrar of Companies. So, the Registrar of Companies, you have to go and file it and say that we are reducing the capital of the company. So, they have given us 30 days for the time limit. So, as soon as the resolution is passed by the company, so within 30 days of passing the resolution, the company officials have to go to the registrar and get the filing done. So, only then this can be done. Otherwise, you cannot go ahead with the alteration of capital. Then, next, I state any 4 differences between internal and external reconstruction. Now, here we should understand that alteration of share capital means, it also means internal reconstruction. Internal reconstruction. So, instead of writing internal, I can write it as alteration of share capital. External reconstruction means it comes under mergers and acquisitions. So, there are, in mergers, you should understand that there are 3 types of mergers. One is amalgamation, other one is absorption, third one is external reconstruction. So, there are 3 kinds of mergers. Now, we have this internal reconstruction concept. So, internal reconstruction is nothing but alteration of share capital. So, that another name for alteration of share capital is internal reconstruction. So, that is why we have written the differences between internal reconstruction and external reconstruction. So, in this we should understand that internal reconstruction means alteration of capital. So, let us understand what are the main differences between internal reconstruction and external reconstruction. So, in case of external reconstruction, one company is liquidated, but in case of internal reconstruction, no company is liquidated. So, in this we should understand that in external reconstruction, one company will be liquidated, and a new company will be formed. But then in internal reconstruction, there is no company liquidation. There is only one company, and in that company only internal reconstruction will take place. Then in case of external reconstruction, a new company is formed, whereas in case of internal reconstruction, no new company is formed. So, in external reconstruction, suppose if the old company is A Limited, then under external reconstruction, you will write new A Limited. So, that will be the new company which is formed after external reconstruction. But then in internal reconstruction, there is no new company. The company will go on in the same name. Only thing is, it will reduce the capital and it will continue in the same name. Then next is external reconstruction can be carried out easily, but internal reconstruction is a tedious process. So external reconstruction can be done easily. We are winding up one company and setting up a new company. But then in internal reconstruction, it is a tedious process because you have to intimate all the shareholders and see that whatever shares they have, it has been reduced, or if it has been reduced, why they are reducing. So they have to give explanation to so many parties and it becomes a tedious process. Then external reconstruction can be effected without court's confirmation, but internal reconstruction requires court's confirmation. So once you're going in for internal reconstruction, though you don't need the permission by the court, you need to just intimate the registrar of companies. The registrar of companies has to be intimated about the internal reconstruction in the company. Whereas in case of external reconstruction, you don't need any such intimation. Then internal reconstruction is a slow and tedious process and has to be approved by all the parties concerned and confirmed by the court. Whereas external reconstruction is a speedy process as it needs the consent of the shareholders only. Now, why should the company going in for reduction of capital? So this will be the first question which you will come across. So when the company is running into huge losses, so when the losses are piling up in the company and the company is not able to meet all its debts, so then it can go in for internal reconstruction. So if suppose the company has large amount of capital in excess, so this kind of excess money in the company, it will be an invitation for all the scrupulous persons, so who will be trying to just siphon out the money from the company. So this excess unused money will be misused by some of the internal office bearers of the company, and as such, to avoid all this kind of cheating and fraud etc. in the company will decide to reduce the share capital. So the unused part of the share capital will be utilized to write off the losses of the company, to write off the fictitious assets of the company, etc. So in this way, the unused capital will be made use of, and in this way the company can also write off the losses. So the fictitious assets like goodwill or loss during the previous year, all these can be written off through internal reconstruction, and then the company can have a new beginning by just having the optimum utilization of the capital, whatever is available in the company. So we should understand that it is a slow and tedious process and has to be approved by all the parties concerned. So whoever are the stakeholders to the company, they have to agree to this internal reconstruction. Whereas in external reconstruction, only the shareholders, if they agree, that is more than enough. But then in internal reconstruction, they have to be approval by all the parties concerned, and also there should be a confirmation by the court. So as soon as you pass a resolution in the board meeting, then you have to go and intimate the registrar of companies, and also then you have to get the confirmation from the court. Then in internal reconstruction, the debtors and creditors generally continue, but in external reconstruction, they are settled by the selling company. So in internal reconstruction, whatever the value of the debtors and the creditors, or the debtors and creditors, they will be continuing in that same business. Whereas in case of external reconstruction, the debtors and creditors, they will be settled by the selling company. So for example, if you are going in for external reconstruction, the old company has to wind up. So when you are winding up all the old company's accounts, you will transfer all the accounts to realization account. All the assets will go to the debit side of the realization account, and all the liabilities are to the outsiders. It will go to the credit side of the realization account. So in this way, you will be just closing all the books of accounts, and when you are closing all the books of accounts, you will be paying off the creditors and you will be collecting money from the debtors, whatever is due from them. And in this way, you will be settling the accounts of debtors and creditors in external reconstruction. So the selling company will settle all the dues and then it will get merged into a new company. Whereas in case of internal reconstruction, there is no question of settling the debtors and creditors, because it is an alteration in the share capital, and whatever the excess money you are having in the reconstruction account, so that you will write off with the whatever the balance is there, it will be utilized to write off all the goodwill, the profit and loss account, and various other losses. It may be the discount on issue of shares, like that. So all these losses will be written off with the help of the balance in reconstruction account. Then in internal reconstruction, the company can set off past losses against the future profits. In external reconstruction, the past losses cannot be set against the future profits of the company. Now, as I told you earlier, in the internal reconstruction, the past losses of the company will be written off. So, written off means, so whatever is the excess amount of capital you are having because of capital reduction, so that amount of capital, you will be utilizing it to write off the past losses of the company. So what are the past losses? It may be the goodwill of the company, which will be appearing on the asset side of the company. Then we also have the P&L account, so profit and loss account balance. So if there is a previous year's balance of profit and loss account, that will be shown on the balance sheet of asset side. So that is a loss to the company which has to be written off, or it may be the preliminary expenses. So the preliminary expenses of the company. So what are preliminary expenses? They are the expenses relating to promotion of the company. So when you are starting a new company, whatever expenses you are incurring, so that will be written as preliminary expenses. And these expenses, a small part of it you will write off every year, what we call as the deferred expenditure. So every year we will be writing off this preliminary expenses, and as such, if there is an internal reconstruction in the company, so you will be writing off this preliminary expenses, profit and loss account losses, and goodwill, and various others. It may be depreciation of the any machinery. Suppose there is a machinery depreciation, so you can make use of this amount in reconstruction account. So you are preparing an account called reconstruction account. So this reconstruction account balance, whatever is there, that you will be making use of to write off the losses of the company. So whatever is the set of the past losses against the future profits. But in case of external reconstruction, past losses cannot be set against the future profits. So in case of external reconstruction, we cannot set off any of the losses. So these are the main differences between internal and external reconstruction. Then next, internal reconstruction may take two important forms. Now, what are the two important forms the internal reconstruction can take? First one is reorganization or alteration of capital. Second one is reduction of capital. So reorganization or alteration of capital means the rearrangement of the following. So again, this is a repetition here. So reorganization of capital means increasing the share capital by making a fresh issue of shares, then decreasing the share capital by cancelling the unissued shares, conversion of fully paid shares into stock, reconversion of stock into shares, consolidation of shares of smaller amount into shares of larger amount, and subdivision of larger amount into smaller amount. The internal reconstruction can take two forms in this. The first form is alteration of capital. Then the second form is reduction of capital. Now, what do we understand by reduction of capital? Reduction of capital is an arrangement under which generally the capital of the members and sometimes even the claims of the debenture holders and the creditors are reduced, and the amount so reduced is used for writing off the accumulated losses, fictitious assets, and overvalued portion of fixed assets. So it may also mean returning the excess capital to the members when a company finds that its funds are far in excess of its requirements. So in this reduction of share capital, generally the capital of the shareholders, so whoever is the shareholder, suppose he has a 100 rupees share in the company, you are reducing the face value of the share from 100 rupees to 70 rupees. So that becomes a reduction of capital. Then, and sometimes even the claims of the debenture holders and the creditors are reduced. So even for sometimes the debenture holders also, they may say that instead of paying 1 lakh to us, you can just settle the account for 90,000. So the 10,000 difference amount, so that you can always credit it to the reconstruction account. In the same way, creditors also, so you can settle the creditors value by just transferring the stock in the company or the debtors of the company to the creditors. So in this way also, you can always reduce the value to be paid to the creditors. So these are the various arrangements in which you can have the reduction of capital. So, and the amount so reduced is used for writing off the accumulated losses. Now, suppose you have a reconstruction account. So you can call it as the reconstruction account or the capital reduction account. So whatever is the value of the share capital, so you will have a balance in reconstruction account. So the reconstruction, suppose you have a balance of 5 lakhs. So this 5 lakhs is there in reconstruction account. So this 5 lakhs you can utilize to write off the losses. Suppose the company has goodwill. So the goodwill worth 2 lakhs. Then it has a loss in profit and loss account worth 2 lakhs. And then there is a preliminary expenses worth 1 lakh. So all these can be written off with this 5 lakhs. So whatever the amount in reconstruction account, you can write off all these losses. So it may be goodwill, profit and loss account, preliminary expenses, discount on issue of shares. So all this you can just write off with the balance available in the reconstruction account. So the amount so reduced is used for writing off the accumulated losses. Now what are the accumulated losses here? The P&L account and the preliminary expenses account. Fictitious assets. So fictitious assets means discount on issue of shares. Then we also have the goodwill, which is a fictitious asset. So all this you can write off, and the overvalued portion of fixed assets. Now what is this overvalued portion? Suppose you have a land and building worth rupees 20 lakhs. Now you find that it has been overvalued by 2 lakhs. So 2 lakhs is the overvaluation. So this extra 2 lakhs, which is the overvaluation, this you can use it to write off with the help of the reconstruction account. So the overvalued portion of the fixed assets can be written off by debiting it to the reconstruction account. It may also mean returning the excess share capital to the members. So whatever the excess capital you have in the company, suppose the shareholder has 100 shares of rupees 100 each. So 100 shares into 100 rupees, it comes up to 10,000. So whatever is the number here, 100 shares into 100. So that will be, if it has been reduced to rupees 50, then the excess amount, whatever here the company has collected in the form of share capital, it will be returned to the shareholders. So when a company finds that its funds are far in excess of its requirements. So if a company finds that the funds are more than whatever it is required, then that extra amount of funds which it has collected from the shareholders, that will be returned to the shareholders. So in this way, we can see that the reduction of share capital, it is a way of writing off the losses of the company, and in this way, whatever the future profits the company earns, it will be available for distribution to the shareholders. Then, Next, reduction of capital may take the following forms: extinguishing or reducing the liability of members for the uncalled capital. Now, how do you reduce the capital? Suppose you have a share of rupees 100. So, this 100 rupees share, 10 rupees you collect as application money, 10 rupees you collect as allotment, then 40 rupees you collect as first call, and again 40 rupees you collect it as second call. Now, you will have 4 calls, that is first on application, first on next on allotment, then first call and second call. Now, suppose the company says that it wants to reduce the value of this 100 rupees share to 60 rupees. So, this value of share has been reduced from 100 rupees to 60 rupees. Now, this company has already collected the application money 10 rupees, allotment money 10 rupees, first call money 40 rupees. So, the remaining 40 rupees, it says that it is reducing the capital. So, this uncalled portion, it can be cancelled. So, extinguishing or reducing the liability of members for the uncalled capital. So, this 40 rupees which has not been called, so that can be cancelled. Then, reducing the share capital by returning that portion which is in excess of the requirements of the company. Now, suppose the company is already called. So, again 100 rupees share is there and they are reducing it to 60 rupees, but they have collected the entire value of the share. Already the 100 rupees has been collected from all the shareholders. Now, this entire portion which has been collected from the shareholders, so you have to return, you need only 60 rupees per shareholder. So, you have to return the 40 rupees. So, this 40 rupees, you can return it to the shareholders. So, the 40 rupees, whatever you are returning, so that also we can call it as reduction in the share capital. Then, third one is writing off the share capital which is lost, which is unrepresented by the available tangible assets. So, writing off the share capital which is lost. So, what is this? You will be writing off the share capital which is unrepresented by the available tangible assets. So, from the part of share capital, you have purchased a machinery and that machinery you have depreciated and it is not existent now. So, that part of the machinery which is non-existent now, so that you can write off the share capital which is not available in the form of an asset. So, this also amounts to reduction of share capital. So, with this we come to the end of this session. Hope you have all followed it. Thank you.